If you've been anywhere near the financial world lately, you've heard it. It's that siren song of a hot new IPO. And right now, the hype around Lenskart is absolutely deafening. Everyone's asking the same thing. Is this the next golden ticket, or is something else going on under the surface?
And that's really the core mystery we're going to try and solve today. When an IPO gets this much buzz, you have to wonder, is this a real opportunity to get in on a great company, or is it just a classic hype trap designed for a quick payday for the early guys?
It's so tough to figure that out, especially when your feed is just flooded with these short videos screaming, "You gotta buy this now." The thing is, you don't really learn anything about the company's actual health, and you kind of just end up relying on someone else's opinion.
Which is exactly why we're here. Our mission today is not to tell you whether to buy or sell. Think of this as us giving you the toolkit, the exact process that professional analysts use to cut through all that noise and find a real story for themselves.
Okay, so let's open up that toolkit. The single most important document you can read for any IPO is called the Draft Red Herring Prospectus, or DRHP. Just think of it as the company's legally binding tell-all book. The only problem? The one for Lenskart is over 700 pages long. It's an absolute beast.
So how on earth do you get through that when the bidding window is just a couple of days? Well, here's a little secret. The pros don't read every single word. Nope, they practice what's called ruthless prioritization. They only focus on the handful of things that really matter. And it all boils down to these 3 pillars. It's actually pretty simple. First, you look for the dangers by analyzing the risks. Second, you figure out the story they're trying to sell you by analyzing their growth. And third, you find out the reality by analyzing their cash flow. If you can get a handle on these 3 things, everything else is pretty much just noise.
So let's put this framework to work right now. We're going to start with Pillar 1, risk. We're basically going on a hunt for all the potential landmines the company was forced to tell us about. This is where we build the bear case, or the argument against investing.
And the very first thing that just jumps off the page is the sheer number of risks Lenskart listed. 85. Now, what's so interesting here is that the number itself is a signal. 85 is a lot, and that alone should make any analyst sit up and say, okay, I need to dig into this.
So what are the big ones in that list of 85? Well, a couple of major operational risks really stand out. First, their raw materials make up almost a quarter of their costs, and they buy them on spot orders. That basically means they have no long-term price protection. They're totally exposed to market swings. Second, a whopping 42% of their stuff is sourced from China, which creates this huge geopolitical and supply chain risk.
But as serious as those are, the biggest red flag of all, in my opinion, isn't even about their operations. It's a governance issue. And it boils down to one simple question. When you buy a share in this IPO, where does your money actually go?
So this is a really crucial point. In a fresh issue, the company makes brand new shares, and all the money raised goes right back to the company to help it grow. But in an offer for sale, or OFS, no new shares are made. The existing owners are just selling their own personal shares to you, the public, and that cash goes straight into their own pockets.
And guess what we have with Lenskart? Their IPO is a 100% offer for sale. Just let that sink in for a second. The company, Lenskart itself, gets $0 from this whole thing. Not a single rupee is going towards building the business. You have to ask yourself, what kind of signal does that send? I mean, a little bit of selling by early investors is normal, but 100% OFS? That's a huge statement. It means the people who know this company best, the insiders, are choosing to take their personal payday right now instead of letting the company raise money to grow even bigger. All right, now let's look at the financials and see how the story develops. To be fair, Lenskart is pitching a really powerful growth story, and a key part of that is this big headline number. They recently reported a profit of 30 crore. That's a huge turnaround from a loss the year before. On the surface, that looks incredible. But when you dig into the actual financial statements, you find something really interesting. That profit, it wasn't really driven by their main business of selling glasses. It was almost entirely created by a jump in what's called other income, specifically an accounting trick called a fair value gain. It's basically a paper profit. It looks good, but no actual cash came in the door from selling more eyewear.
And this kind of financial engineering kind of messes with the whole growth story. For instance, they're claiming this awesome international growth of 25 to 30%, but it turns out that came from buying another company in Japan. If you strip that purchase out and just look at the real organic growth of Lenskart's own international business, that number falls off a cliff to just 4%. See? That difference is why this detective work is so important.
But again, to be fair, let's flip the coin and look at the other side. The bull case for Lenskart, the reason people are so excited, isn't really about its current financials. It's based on a massive, undeniable future market opportunity. This is the story they're selling to make you look past all those risks.
And honestly, the opportunity is genuinely huge. Just look at this comparison. In India, only about 35% of people who need glasses actually have them. But in a place like the US, it's almost 90%. That massive gap represents a gigantic runway for growth right here at home.
And the numbers that back up this bull case are pretty convincing. Projections show that over half the world's population is going to need vision correction by 2030. And in India, the physical retail footprint is tiny. I mean, just 60 eyewear stores for every million people. Compare that to something like jewelry, which has over 1,000. The potential to just open more stores is massive.
And this brings us right to the heart of the matter. This is the central tension of the entire case. You have this huge, can't ignore it market opportunity on one side, and some really concerning financial and governance red flags on the other. So how do we put all these clues together?
Let's just lay it all out side by side. The bear case is pretty clear. 100% OFS means insiders are cashing out, the profits look a little engineered, and their real organic growth is weak. But the bull case is just as clear. The Indian market is wide open, global demand is set to explode, and there's a ton of room to expand. So, whenever you have such a strong conflict between how a company looks today and how it could look in the future, the entire decision really just boils down to one final critical factor: the price they're asking you to pay.
And the rumored valuation for this IPO is a price-to-earnings ratio, or PE, of around 230. To put that in perspective, a solid, stable company might trade at a PE of 20. At 230, the market is pricing in decades of perfect, explosive growth before you even buy your first share. The expectations are just astronomical. So we'll leave you with this. The whole point of this was never a buy or sell call. It was to give you the tools. And now you have to weigh the evidence. On one hand, you have a powerful, undeniable growth story in a massive market. On the other, you have weak financials, some questionable moves, and insiders running for the exit at a sky-high price. So the question is, which narrative do you trust?